Welcome to today's webinar, compiled and produced by the team at biznews.com. All of our webinars are interactive. We encourage you to pose questions to our guests. The more challenging, the better. And the earlier you get the questions in, the better the chance of having them answered. The recording of this webinar will be available later today on the biznews.com channel on YouTube. Hi there, I'm Alec Hogg, and very good to be with you today. We have got a webinar of note, as always. We'll be giving you the details of what happened to the portfolio, and I'm also taking a little bit of a retrogressive and having a look at what has happened to this portfolio since the pandemic hit. But first of all, my colleague Stuart Lohman is with us here. Stu, do you want to go through the technical issues?
Thanks, Alec. I see we're on the two-camera split there. It's nice.
No, I'm impressed. We're now starting to show that we kind of BizNews is getting more professional.
Oh, for sure. Just quickly, if those on the webinar, if you can hear Alec and myself and see the presentation underneath, there is a little high five button on the control panel on the right-hand side. I see there's some high fives coming through. That's great, and I hope the volume is loud enough. It sounds good on our side, but just let us know. We do also like to keep it conversational. There's a little questions dropped on that same control panel. If you can please drop your question in there, I'll pass it on to Alec as he goes through. I see you've already got one there, Alec. So
it's not a question saying I can't hear you.
No. This is a
proper question. Ready, steady, go. Okay. Well, there we go. As you can see, Stuart and I are now we're getting quite good at this flicking between cameras, because we have on the BizNews Power Hour every night, we have a market report where Stu and I are here in the Johannesburg studio, and then we bring in our two colleagues based in Cape Town, or our two of our colleagues based in Cape Town, Nadia Swart and Justin Rowe Roberts. They also join us to contribute to the intro to the show. So it actually has been working real well, Stu, and I think it's starting to get a little bit of traction. We pre-record that every afternoon at 4 o'clock. Yeah. So if you want to hear the latest in the markets, join us at 4.
Yes, 4 on the BizNews TV channel on YouTube, Alec, and then obviously it plays out in the 5:30 live show of BizNews Power Hour. So, and there is many repeats as well, 7:30.
Many repeats, yeah. 7 o'clock. I've got that right, by the way. I know we've had some complaints that the show was from 5:30 to 6:30, but then going straight on again. Well, I've fixed that now with the tech. I got the tech right. So it's 5:30, 7 p.m., 7 a.m. And if you want to listen on free-to-air radio, it's 5:30 on Fine Music Radio in Cape Town, 7 o'clock on High FM here in Johannesburg. Okay, that's enough for the background, and just to make sure that we're both here in studio. We're not cardboard cutouts. We will be coming back to you later in the program, but really the focus now is very much on what is happening in the portfolio. I've got, as per always, a little presentation for you, and then as we go forward, we will be taking questions. And as Stu said, on that little question bar on your control panel, there's a little question mark. Just click on that, and then you can type in your questions. You can see the big number there, compound annualized growth rate of 21.1% in dollars. That's phenomenal. We've managed to keep it going, I think, helped a heck of a lot by the performance of the portfolio in the pandemic, and then in rand terms, just over 26%. And the reason for that is the weaker rand relative to the US dollar. Remember, the portfolio is going to end. This portfolio is going to end. We'll keep it. We'll keep updating or keep showing you, but we will be starting a brand new portfolio in December. Many people have said that's like crazy, because why don't you just keep riding your win? But that's fine. But we serve our community, so we're going to try and restructure a portfolio. And there are lots and lots of people who've actually been asking me to do that, to begin again. so that they can start from the beginning. But those who have been invested in this portfolio, you'll be able to keep it.
I think with as a virtual portfolio as well, like people come in at different times. So I think it's very nice, as you say, for the community, because this is what, 7 years now. So
it'll be 7 years in December. Yeah, quite extraordinary. And you'll see the power of compound interest in just a moment. But let's begin at the beginning. And there we go, the past month's movement. Now, what has been interesting in this past month is that we've had some very big increases and very big declines. Wilson Bailey came out with financial results. This is a company that is hugely undervalued. It's a construction business. If you think about the way capitalism works, you have a lot of companies competing with each other in a particular sector. Then in downturns or because of excess competition, some of them go out of business. The ones who left earn excess profits, and they eventually attract more competitors, and then the profits stabilize. Now, if you just use that as an example, Wilson Bailey has come through a very torrid time for the construction sector, where many of its competitors, think of Group 5, think of Avenge, which is, okay, it's 6 cents a share now, but it was 1 cent a share and was a multiple of that not long ago. There's Basil Reed, a whole bunch of South African companies in the construction sector who've literally gone to the wall. And Wilson Bailey, being the blue chip, is still there. It also owns a very big business in Australia, which would have been sold to the Chinese. There was a Chinese bid for it, but the Australians, through, I suppose, patriotic nationalism, didn't want a big company like this, or such an important company in the economy, to be sold to a Chinese owner. And that was part of the reason why the Chinese and the Australians are at each other's throats at the moment. They really are not. Chinese are not, for instance, importing Australian iron ore. It's quite nice for South African iron ore, but the Australians are continuing to ask, where did the COVID-19 virus originate? So it's a real story, which Wilson Bailey got caught up in. Had Wilson Bailey's Australian subsidiary been allowed to be sold, the share price of this company would have been substantially higher. But anyway, it is where it is. It's the numbers that came out from the company were very good, and as a consequence of that, we saw in our portfolio, it's up 14%. Netflix was interesting. After coming out with results, which was more than a month ago, share price came down, it bumped along a little bit, and then there was a very modest little announcement for Netflix to do with something that relates to Apple. If you watch Netflix and have you got AirPod Pros?
No,
just normal AirPods. But the AirPod Pros, you can now, it's like surround sound. They call it spatial audio. And you can also, when you put your headphones, your Apple headphones on, it's like you're listening through speakers. So, which is really strange, because you put the headphones on so that you get a better sound quality than speakers. But if you put the spatial, it's all to do with Apple technology. And I must say, I'm having bought a new desktop, a smaller desktop from Apple yesterday, and just looking at it, man, they make amazing products. Not only are beautiful, but anyway, so they've done this for Netflix. Netflix is now a better experience through Apple devices, whether you're watching on your phone or you're watching on your iPad or your desktop or using your Apple AirPods. And Netflix's share price, would you believe, jumped on that news. So it's been up by 7% this month. Microsoft is just powering stronger, ever stronger. And you might remember, those of you who've been following the portfolio for a long time, we went into Microsoft when they moved to having an automated revenue model. And that means that you renew your subscription, and usually on an annual basis, and then they keep upgrading for you. So that's the Microsoft model, and it's really pumping for them. Lovely to see Xero in Aussie dollars cracking 150 Aussie dollars, which is $108.50 in US terms. I know there are a pile of our community members who bought into Zero. So you'd be happy to see that. Of course, the Aussie dollar doing quite well against the South African rand as well. Apple was stable. Purple Capital, which is the way into easy equities, pretty stable. It's had a fantastic run recently, though. We unfortunately bought it over 3 periods, and the last of the 3, we had to pay up for the purple shares. But anyway, we're still looking in quite a nice profit. In the last month, that went down slightly. Spotify has been bumping around the place. Just look at it from the long-term perspective, and if you use Spotify, you'll know why I'm so bullish about it. Amazon was an interesting one. Now, Amazon's decline of nearly 12% followed the announcement of results on the 29th of July. Interestingly enough, both Amazon and 2U announced their results on the 29th of July, and both of them were not, or Mr. Market was not impressed by both of them. So let's just go very, very quickly through that. Amazon's operating cash flow was up 16%, so it's below the 20% that we like to see, but revenues were up by 27%. So it's very, very much still in the exponential business. When I look at these companies, what I want to see, with the exception, I suppose, of Wilson Bailey, which is a turnaround situation on the South African construction sector, from every single one of the other ones, they've got to be growing revenues at 20% plus. And Amazon grew them at 27% after the revenues were actually coming back a bit. So that's good news. Andy Jassy, the new chief executive who's taken over from Jeff Bezos, presented the first set of results. Maybe investors are looking at him and thinking, he's not a Bezos, whatever. The fact was the free cash flow was also down from 32 billion to 12 billion. But we know with Amazon that they invest heavily. It's a bit like a steamroller, and one quarter they'll put a lot of money into it. It's such a massive business and such a strong business. You could almost say at $32,500, it's worth buying one. It looks like a buying opportunity, certainly compared with the pre-results level of $37,000.
They're also going into retail, aren't they, Alec? The hard stores.
That was recently, and that was after the share price had come. In fact, that helped the share price up a little bit. The share price fell on financial results, and that's, if you're a smart investor, you should just wait for the quarterlies, and then in a case of Amazon, if Mr. Market is unhappy about the quarterlies and there's a reaction, and as you can see, it was nearly a 12%. In fact, there was a 12% decline, more than 12% decline after the quarterly results came out. That's the time to be buying, rather than to be buying at $3,700. However, what we do know here is that it can go the other way as well. Often Amazon have come out with results and then gone up 10%. So you got to be careful. But it's a very good point that you make, Stu, about the moving into bricks. So you'll have a real clicks and bricks story. What Amazon has been doing, and in South Africa, we're a little bit removed from this. We don't really get the strategy because they aren't operating here. They've given it to take a lot. For how long, one doesn't know. They've made that huge investment in Cape Town. I think it's a 14 billion.
For the headquarters.
New headquarters. But at the moment, that looks like it's going to be more Amazon Web Services and more the maybe call centers and things like that. But you make that kind of investment, surely you've got to be looking at it. Of course, Andy Jassy, we ran that story recently showing his South African
connection. Yes, I'll actually put the link on for the listeners, Alec.
Yeah, it's a very good South African connection there of the new chief executive, who in fact was the guy who built Amazon Web Services, but came from South Africa. He's not a South African, but he spent a lot of time here. So I wonder if they're going to come into the South African market in future. You almost got to believe it. But let me just tell you what they're doing elsewhere in the world. They've linked up with retailers, because quite often when you buy something from Amazon and they deliver it to you and you're not home, every time they have to come back to your home, obviously it's costing them money. So what they do is they have a safe spot for you to go and pick it up from. In the UK, for instance, certainly when we were living in Weybridge, there was the local Morrison's. was a place. And usually what you would say was, rather than trying to be home, because most people in those days anyway, it was pre-pandemic, were not home at the time. So you'd say, drop it at Morrison's and we'll go and pick it up there. You go into a little kiosk at Morrison's, and there you get your Amazon product. And you literally, I tell the story often of Jeanette buying a blackboard marker or a whiteboard marker, £2 or something. And there it was the next day, delivered at Morrison's. So it's not surprising that they've had a good look now at retailers, and they're probably saying to themselves, hang on, if we had our own points of presence, that would cut X amount off our cost line. And they're moving into it. They're going to move into big box retailing operations in the United States first. But you can see the way that Bezos and certainly the whole culture is one of cut the costs, give a better service to people, and find ways of adding value. And I think that was a very positive move, that they're going clicks for bricks. Because why should you just be boxed into something because the world says you should?
I agree, and they've probably got such a wide array of data points, Alex. So the bricks are probably in really strategic points as well with regards to orders and stuff. You can only imagine what happens behind the scenes. I'm sure there's a lot of thought that's gone into it as well. And I agree with you. Find a balance, not just one or the other, but do both. So.
Do what makes sense.
Yep.
And that's what Bezos has always done. He's always put the consumer at the center of his universe, and then done what makes sense afterwards. Okay, and the other one that took a knock, 20% down, just when we thought it was safe to start celebrating 2U turning around, 2U drops by 20% again on financial results. Now, I'm really not sure why Mr. Market didn't like the results. It could be a consequence of 2U being a relatively small cap. Their market cap is a lot smaller than most of these other companies. They are the global leader in online education. The bulk of the revenue that is generated is through university courses, and they're now working more and more with universities. They've got 84 universities who are partners of, or 84 universities are partners of 2U. They've got 350,000 students, and these students primarily are getting university degrees. You could do it from South Africa, sign up with 2U and get a Harvard degree. Literally, that's what they do offer. What happened in earlier in this year was they raised, the management team there raised $475 million. So the company, which is now cash flow neutral, is sitting on $971 million in cash. With a rapidly growing company like this one, revenues for the quarter to the end of June were up by 30% year on year. And actually, what I'm just going to share this with you, because I think this is where Mr. Markets kind of got it wrong. He's had a look at 2U on the revenue growth. So you would take the second quarter of this year and compare it with the second quarter of last year. And going back to the first quarter of 2000, the revenue growth was 44%, 35%, 31%, 32%, 32%, 30%. Okay, so that's quarter on the previous quarter a year ago. However, this is distorted by acquisitions. So during that period, they made quite a few acquisitions. If you go to what I think you should be looking at with any exponential company is, what is the organic revenue growth? If you take out any acquisitions, what is the organic growth? And going back in the last 2 years, the quarterly numbers are 13%, 15%, 18%, and then jump to 31%, 32, 32, 30. So rather than comparing the 30 with a 44 of a little while ago, I compare the 30 with a 13, and I say, hang on, this company is still hitting its straps. And as you can imagine, when you've got a company growing at these kind of exponential rates, to add 30% growth to where you've grown in the last year is more difficult if you've grown 30% there, etc. So they're growing at 30%. I love it. They are cash flow positive, have been, and that's also quite a nice number to look at. Just listen to these. In the last few quarters, their cash flow was minus 99 million, minus 80 million, minus 58 million, minus 44 million, minus 9 million, minus 4 million, and then positive 9 million. That's a good graph. And then positive 2.5 million in the latest quarter. So again, like Amazon, investing more, but they've got $970 million in cash. Heavens, you can't expect them now to not use that 975 million. If that was the case, then we're the management in this company. I love 2U. I just love the company, and I love the results. I was very, very happy with the results. Mr. Market wasn't, knocked them down by 20% on I think potentially a misinterpretation, and as a consequence of that, 2U is now really appealing and quite attractive. And well, you got a bit of cash. Maybe we would be looking, if there's any further weakness, to top up that holding. So that's what happened in the past months. The portfolio value, as a consequence of those big declines in Amazon, which is a huge part of the portfolio, was down 2.7% in US dollars. The rand weakened in the past month, and so it was down 1.2%, but it doesn't really show you the full story. I just wanted to pick this up because we've had a little bit of questioning. Why did you sell the shares you sold? Were you panicking, etc.? Well, Discovery has gone up as in the past month. I'm still not happy. I don't think that anybody who's had a look at the precipitous plunging in the share price of Ping An Health, which is listed in Hong Kong, which is down by more than half in the last month, would be interpreting Discovery as positively as some people have been doing. I know that Kathy Wood from the ARK funds in America has become a shareholder, and maybe people are following her. I don't know if Kathy's really got it, that they own 25% of Ping An in China, and there has been a massive wipeout of that sector because, as we mentioned last month in some detail, the Chinese government, President Xi, is moving to a different model. He's moving back to communism. He's saying, we don't want these companies making money. We want these companies to give the money back to the public. And you can see there, Naspers, after bouncing around a little bit, down 8% in the past month. And I still think that you know what Warren Buffett says, go to sleep at night, sleep well on your portfolio, and then you're happy. If you don't sleep well, or if you're concerned about something, then maybe you should be getting out of the stocks or some of the stocks that you own. What worries me is that tomorrow morning we can wake up and the Chinese might have decided just to nationalize everything there. That's the way they've been operating. So, Stu, I don't know if you think I may be getting a little bit too concerned here, but you make long-term bets, and the long-term bet for China is not going to be thriving corporations.
It's very difficult to judge, Alec, because I saw Kathy Wood's actually just gone back into China now. She cleared all her position, and now she's gone back into some of the stocks there. And I saw today Tencent started their buyback program today. It's just very hard to know what's going on. So, like you said, it's better to sleep well at night than to worry about what's going to happen while you sleep.
Yeah, the Tencent buyback program is hopefully going to be more successful than the Naspers buyback program. Our colleague Justin Rowe Roberts did an analysis and discovered that Naspers has dropped 20 billion rand on their share buyback program, i.e. they bought them at much higher prices. And the other thing that you've got to just pause a little bit to suck up to government in China, Tencent literally gave $7.7 billion to a fund that is going to be used to redistribute wealth in that country, $7.7 billion. Translate that into Naspers, which owns 29%, Naspers Process. That means they put in 34 billion rand. 34 billion rand. So Naspers is actually 50 billion rand behind in net value after its share buyback and just the contribution that it's had to make to the Chinese government. That's sending a signal. And then Tongaat, I see it has been going up a little bit recently. There are rumors there, and for what they're worth, that Cyril Ramaphosa's son is going to buy all the property and off Tongaat. Well, maybe and maybe not. I think given the politics of this country, that would be quite a quite a statement if he were to do that. And because of the association with Ramaphosa, you've got to believe that if Andile were to do that, his dad would give him a swatter across the ear. He's the last thing Ramaphosa needs now is to be showing his massive wealth. But Tongaat is in KwaZulu-Natal. It's exposed to sugar. It's got a great opportunity going in Zimbabwe, but it owns a big part of its portfolio is property in KZN. And after the riots last month, I'm not sure who's going to be investing in that property in the near future.
I think there's three risks there, Alec. Sugar is something that lobbyists want to take out of diets, etc., and land in South Africa is a big debate. So all three of those are very risky.
But land in KwaZulu-Natal,
even, yeah.
That was remember I said I was really excited about Zim and the turnaround, and I still think Zim's is a turnaround situation. But the alternative to that here is KZN, not so clever. Anyway, so that's the story. We're happy to be out of those. I'm not going to be returning to them every month, but I do think that it's a good idea, just as a consequence, to have a look at what happened subsequent to our sale. And then here, from a historical perspective, this is going back to when we started on the 5th of December 2014. So it'll be 7 years on the 5th of December this year, and that's why we'll be closing off this portfolio and starting a new one. You can see it's gone from $200,000 and a starting point of 2.254 million rand, and the compound annual growth of 21% and 26% has taken us to 11 million rand and $728,000. So just pause on that for a little bit. The US dollar compound annual growth rate, 21% a year, and that has turned $200,000 into $728,000. So it just shows you all you need to do is put your money in and then just let it grow. So what is interesting here is the Apple continues. It continues to go stronger. Those of you who know the Apple story and the ecosystem, and they just keep bringing out brilliant products. To have between Apple and Amazon nearly half of the portfolio invested there, add in Microsoft, and you have got half or over half. You have seen, if you'd sold any of these shares any time in the last 7 years, you would be kicking yourself now. So very happy to have those three. I'm still worried about Facebook and Alphabet, but there are others who are quite happy to take the risk, and they've also performed really well over this period. So that's the portfolio as a whole. I just wanted to quickly go through a couple of other charts to show you what's happened in the pandemic. As you can see there, March 2020, the portfolio dipped because of the pandemic quite significantly to $388,000. It's now $728,000. So it's been an amazing run in the last 18 months. It virtually doubled in value. And part of the reason for that was that we did go big during March and made some significant investments, which liquidated some and then made some significant investments. Particularly good for us were Discovery and Sasol. Sasol was almost a 10-bagger in this portfolio, from 28 Rand to 145 Rand. And had we held on to it, we could have been a 10-bagger, but it had done a huge run. And there's the valuation of the portfolio in Rand, 6.75 million to now over 11 million. And I think what that tells you is that Buffett knows exactly what he's talking about. That when Mr. Market panics is the time for you to have courage. Have a swing, look at the fat pitch and give it a full go. And at the time, we knew that the authorities were going to be creating money out of thin air, and that is going to inflate asset values, and surely it did. So the historic stock performances, there you can see 2U is our little sore thumb. Spotify is unfair because we've only brought it in the portfolio in the last couple of months. You might remember we had it, we made a lot of money out of it, we sold during a time it was looking a little bit dodgy, that the tech stocks might have overdone themselves. We bought back in at much higher Rand prices, and the Spotify, or at a much stronger Rand rather, but now Spotify's come back again. So if you didn't buy Spotify shares, they're offering great value at the moment. And the rest of them, even Netflix is up more than double, and we haven't had that for too long. And that's just a graphical performance. Thank you, Apple, Microsoft, and Amazon, and Netflix coming to that party as well. Okay, Stu, so that's the first half, if you like, of today's presentation. Shall we pick up on questions?
Excellent, thanks. Tumelo just has a point on 2. He says, was it not potentially affected by the Chinese crackdown on private education?
Should have been the other way, because
Yeah.
it's its competitors who've been nailed. It's Chinese companies that have been nailed, not American companies. So no, I shouldn't think so. I really don't. It baffles me, this company, or the markets, the way that the market has reacted to this company. But it could also be the fact that it's relatively small. It's only $2.7 billion US, and it's in a multi-trillion-dollar area, education, and particularly tertiary education. So it's a little exposed. You know, the biggest mistake I've made this year was selling Cloudflare. And Cloudflare, which we sold it in the 60s because it looked horrifically expensive at something like 100 times revenues, is now doubled since that price. Cloudflare is $40 billion market cap. There's no reason in my head why 2U shouldn't be a substantially higher market value than 2.7 billion. So, and particularly on that Chinese story, where the competitors, it's a little bit like looking at TikTok competing with Twitter and Facebook and Instagram. In that TikTok is from China, it's come into the Western markets, it's got another product. It can at some point in time take away market share, but now, of course, the Chinese government has stepped in, so that's unlikely to happen. But you think about 2U, it's the market leader in a field where the Chinese were getting better and better in private education, and now President Xi has just killed that sector completely. So it should have improved. Logic suggests anyway. The 2U share price. No, it was a direct reaction to Mr. Market not being impressed with the financial results, and I guess it depends on how you want to analyze it. But we've seen this movie many times, that we've had this portfolio over the last 7 years, is that Wall Street looks at the headlines almost like they look at the newspaper posters. The traders, they then take a decision based on what the posters are saying without actually reading the story.
I agree, Alec. Pitt touches on the Cloudflare that you just mentioned. At the time, I thought you were selling because of Ray Dalio's view on bubbles on secondary tech stocks.
Yes,
panic
I was.
selling.
Yeah.
He says, with the benefit of hindsight, why did you deviate from the principle forever?
Yeah.
And then he mentions it trading at $100.
Kick my butt. I mean, it was really a misstatement. And Ray Dalio, well, not Ray Dalio so much, but Howard Marks came out a little bit later and said, well, he'd spent time with his son, who'd convinced him that you can't look at these exponential companies in the way that people like he and Ray Dalio used to look at them in the past. I think Ray Dalio is he's an absolute genius when it comes to investing, but it doesn't mean that he's infallible. And we've seen from this, it was a worry that was coming through the markets on what are they called, emerging companies, emerging tech companies. What bothered me about Cloudflare was it's getting to break even, like Zero, remember, and the one we've just spoken about now, 2U. If you stop and have a look at an exponentially growing company, what happens, and the 2U story is really quite instructive. You get massive cash flow outflows until you get to the tipping point. Now, 2U, just listen to those cash flows again. Third quarter of 2019 was $99 million. So about $100 million cash outflow in that quarter. The next quarter was down to 80 cash outflow, then 58, then 44, then 10. Man, you want to get onto that train. Then 3, then it's positive 9. So it's actually going in the right direction. Mr. Market maybe looked at that and said, but I wanted 20 million positive this quarter. I say, but that's crazy if you're sitting on $970 million. and you've got a market that is still developing, and you are the market leader, get in there, develop, invest, spend money, produce get you've already got the platform, make it bigger. And that's what Cloudflare's done. And yeah, it was a mistake, and a bad mistake, a bit like my Tesla mistake. You know, if only we stay with it's funny that, isn't it, Stu? Well, I suppose, look, we've had enough that we did sell, you know, you can imagine Metrobank at £30 and it's now £1. And there were Barclays was another disaster. But with exponential companies, you pretty much, if you've got the cash flows coming right, and there's no threat to the business anymore of going bankrupt, because that with an exponential company is always your problem. If you're growing so rapidly, it's sucking in cash. And if something jolts you, a new competitor, or the economy turns or something like that, if you are cash flow positive, you can't go bust. But if you're cash flow negative, you're always threatened. And I think the mistake I made there with Cloudflare was I didn't actually put it in my head and say, hang on, but these guys are now cash flow positive. They're okay, and they've got a fantastic business model as well. I love Xero, cash flow positive, continuing to grow exponentially, and to use in the same league.
I suppose Talib's quite important there, because you know, it's like who's the big short guy, Michael Berry. You know, he's called one right, but if you read Talib, you don't really expect him to call another one right because of the randomness of most things in life. It's similar with Dalio and all these. Yes, but you've got to be careful moving forward on what they project and expect, because it's all random.
Yeah, and what Nassim Taleb says as well is, don't use the past to try and predict the future. And that's what Ray Dalio was doing with his bubble index, and that's what the rest of us were doing by following him. So we just don't know. We're in I should know better than this. I've been going to Davos, or I used to go to Davos for over years and years, and I saw this whole move towards the fourth industrial revolution. For heaven's sake, I was sitting in the room in a small breakfast. Tom Friedman from the New York Times was moderating. He'd seen me and said, come along to this thing. And he had the two guys who'd written the first book on, they called it the second industrial age, Ben Johnson and McAfee. You can look that up, Bryn Jolfson and McAfee, two MIT professors. And it's a fantastic book called The Second Machine Age, from which about 2 years later, Klaus Schwab then took it over and called it the Fourth Industrial Revolution. And because Klaus Schwab is the chairman of the World Economic Forum, and he's got more clout maybe than Bryn Jolfson and McAfee, we now all know it as the Fourth Industrial Revolution. Goodness, I was there at the birth of it. So I should know these things. And yet you can still, doesn't matter how much you're exposed to it, you still get, Mr. Market can still knock you off your trail sometimes. But we know where we are now. Anybody who's sold an exponential company anytime in the last 10 years, the right kind of exponential company, one that isn't just bleeding cash indefinitely, will be kicking themselves.
For sure, Alec. Tumelo, just on these exponential companies, have you looked at Walt Disney in comparison to Netflix?
It's a good question, and it's one that's often asked. My colleague, our colleague Justin Roberts, did an interview with the CEO of BritBox. Now, anybody who's spent any time watching British television will know that they've got a fantastic product, and BritBox has just come into that market as well. But Scott Hastings, who started Netflix, has been saying continuously, he's not competing against BritBox and Walt Disney and HBO and all of the other streaming services, or Apple TV and Amazon Prime. He is competing against the leisure time that we have. And actually, his biggest competitor is network TV. Well, now that you look back at it, how many people watch network TV? I tell you what, 3 years ago, if you said network TV is a competitor to the streaming services, it didn't seem rational. It seemed as though, well, we're all going to be switching on the news at 8 o'clock or watching whatever the favorite soapy or whatever it was through network TV. But we've seen that transform so rapidly, and it's a little bit like what's happening in audio with Spotify. We listen to radio, free-to-air radios, only until we discover podcasts. And when I've been banging on about this for a few years. In the initial stages, you look at it and you think, oh no, what's this guy's problem? What is he? Does he think that that we're all going to change our minds? A little bit like I remember in the early days of the internet, people saying to me, "Oh, that's fine, but yes, I can see it's a better distribution platform, but actually, I like the feel of it of a newspaper." Come on, it's just it's like it's craziness. When we try and look 5-10 years ahead, that might be a time when Walt Disney and the other streaming services and Netflix are competing with each other. But until you get until network TV kind of disappears, a little bit like newspapers disappear, only then is the cake of a size that the players will then need to compete with each other. At the moment, they're just pulling market share from network TV. So no, I don't see Disney as being an issue at the moment.
I was saying, former FNB CEO Michael Jordan tweeted a pic this week, Alec, on a newspaper clipping from 1963. Had a picture of this woman with a phone in her hand, just cordless. And he said, you can imagine what was said back then on cordless phones and how the world has progressed since. And it's just that same. It's hard for people, I think, to look beyond what is in front of them sometimes.
We heavily invested in the status quo. We all are, and that was with the there was a on the premium newsletter about a week ago. I took a story that Jason Zweig from the Wall Street Journal had written, their personal finance consultant, columnist, and he explained why, using Daniel Kahneman, remember, thinking fast and slow, or don't think. Thinking Fast and Slow. Anyway, brilliant book. And he said that if you're invested in something, and they've done many, many studies on this, you think it's worth more than it is. So rather get back to what Buffett says, just try and remove yourself from the emotion of an investment. Investing, he says, is not rocket science. Just don't get caught up in the emotion.
Just on Tesla, Peter says it's trading at a good price now, Alec.
Yeah, it's like Bitcoin's trading at a good price now. I don't know, Peter. Some things are just, again, to quote my guru, Mr. Buffett, you got three boxes where you put your ideas, your investment ideas. The one box that's very small is, yes, these are ones you should buy. The one next to it, which is a bit bigger, is these are stocks you should avoid. And then the one that reaches to the ceiling is just too tough to call. And when I look at Tesla and I look at Bitcoin, there are so many arguments pro and con that for me it's just too tough to call. So good luck. I hope you make a lot of money out of Tesla.
I suppose it goes to how well you want to sleep at night as well, again, Alec, because they do swing quite wildly. So.
Yeah, look, Elon Musk he's a genius. He's got the zeitgeist of the moment. He's on Twitter. They love him. They hate him sometimes when he pumps and dumps the certain cryptocurrencies like this Dogecoin. But he's a phenomenon. And who are we to criticize? It's a whole generation that believes that Elon walks on water. So as long as they believe that, Tesla will thrive.
Reynolds just asks, how do you see the monopolistic appearance of Amazon and the risk of action taken against them?
Yeah, it's a good question, Reynolds. The Democrats are very keen to attack big corporates, a little bit like what happened in the 1920s when American politicians introduced antitrust actions, broke up Standard Oil of John D. Rockefeller, and attacked big businesses. The difference with this, though, is Rockefeller was profiteering. Amazon isn't. Amazon's actually cutting prices, and it's using scale to bring prices down continuously. And some of the others would be more exposed towards antitrust possibilities, but and you think immediately there are Facebook and Google, who between them have got 80% of online digital advertising, but they've just perfected the model of online digital advertising, whereas the incumbents, the old media companies, just haven't been able to use tech as well, etc. Over the past 2 years, there's been quite a lot of work done about antitrust of the big companies or big tech. But it's almost like since China started going rogue against capitalism, that the Americans have been a bit quieter now. You would have thought that when Biden came into office, because those antitrust committees were heavily dominated by Democrats, not surprisingly, because you understand the different ideologies of the Democrats and the Republicans. Republicans pro-business, Democrats not always so. So you'd imagine that by now the Democrats would have gone hell for leather, but they're politicians at the end of the day, and the Democratic Party is under a lot of siege. They're likely to lose the midterm elections, and it's crazy. It's just coming. It's around the corner. He's at the middle of his term almost. And the way things are going at the moment, the Democrats are going to get a real hiding in the midterm elections. Of course, things could change, but what happened in Afghanistan would certainly not have improved their prospects. So the last thing they want to do is to have some kind of an attack on American institutions at a time that American public feel that's not popular. So I don't know. It's again, we know about a tiny little slice of the world, and we need to maybe concentrate in that area. And if we know about that slice, the big stuff is so hard to call, but it's nice to speculate about it anyway.
Yeah, Paul adds a few lines. He says, I like to believe that a company like Amazon would have a plan B to benefit from any forced regulatory changes. So in my mind, not a factor influencing ownership in the long term.
Well, plan B is courts. It's the court of law, and they will just tie them up. You think Zuma's Stalingrad strategy is effective? Wait until you see American corporates go to court. They just drag it out. I was reading that fantastic book, Empire of Pain, about the Sackler family and Purdue Pharmaceuticals, who were the initiators of Oxycontin, which is an opioid that has killed 500,000 Americans. What they did was they marketed to doctors who then prescribed it, and it was like giving people heroin. After a little while of taking these painkillers, you became addicted, or many people did become addicted. And the company's bankrupt. The families had to pay, I think, $4 or $5 billion. Johnson & Johnson, it was the second biggest in that field in opioids. It got hit for over $10 billion. There was a huge settlement just the other day between Johnson & Johnson and its distributors. But you just don't know when that's going to come, when something like that is going to happen to you. So what did I know about opioids beforehand? Nothing. Reading about it, you see that there's a heck of a lot going on in the world that we don't actually grasp and understand, and that's why it's a fascinating world to be in, to remain curious in, to start unpacking, and as you learn a little bit, you can broaden your own circle of competence, and that makes you a better investor, I think.
I was saying Netflix is also, that's why I like Netflix, because they do a lot of documentaries around that. And that opioid crisis, there was a big documentary they did before it became so mainstream in terms of the coverage. And I think they do that quite a lot. And I think that's one of their key values behind the product they produce.
Yeah, we like it. We like it when we get when brands that we want to associate with do good.
No, sure.
We do. The whole Jeffrey Epstein expose on Netflix as well. That's something that also appeals to us. So my sense on these things is that if you kind of get the story of the company, if you get what they're trying to do, and the numbers support what they're telling you, And you've got a guy like a Jeff Bezos who's been at it continuously for the last few decades, and he hasn't deviated from his plan. And the people who follow him haven't either. Think of Apple. When Steve Jobs died, I'm sure many people thought, well, that's the end of Apple, or anything but. They have continued. He's embedded this culture, this philosophy of innovation, of attacking the world where art and science intersect. And that's why the ecosystem that Jobs thought up is so powerful now with Apple. They make outrageously brilliant products. So if I use the Apple products, I'm going to buy the Apple shares. If I watch Netflix, and I think I also like the fact that they do things like the opioid crisis and tell me about Jeffrey Epstein, not in a sensationalistic way, but in a good factual way that it informs me and does good for society, well, I'll also be happier investing in that company. And that's what it's about, Stu. If we get the story of the company, where it came from, there are enough companies where you've got poor managers who are in it for themselves. Those guys you can keep. When you're going into the wonderful saying that Steve Jobs will always be remembered for, when he interviewed the CEO of Pepsi-Cola, Scully, and he said to him, do you want to continue making sugar water, or do you want to change the world?
Timothy asks, is the portfolio sitting with uninvested cash from previous sales? And if so, what are you likely to do with it?
Yeah, Timothy, that's a good call. We have got plenty cash. We're sitting at 16% of the portfolio in cash. As you can see there, $115,000. Looking at the moment, but not having found anything that we're going to go into just yet. Remember, one of the problems of this portfolio is that you can only trade, if you like, or buy or sell once a month. I will be very, very loath to sell anything unless there is a change in the fundamentals to the company. That's really the way we've been. We haven't traded the portfolio at all. But when there's been a change in the fundamentals, or as we've discussed at some length in this webinar, when you get someone like Ray Dalio telling you that emerging tech stocks are in a bubble, then you need to take that seriously. But I think to you, as we sit now, would be an obvious investment, as would Spotify at these levels. So, and both of them are relatively small holdings. It's always good. It's like with a big company, when you see a company making an acquisition of something that it doesn't know a heck of a lot about, goes into a new field, you've got to be dubious, or certainly the risk is higher. But when they do bolt-on acquisitions, they are always the best. In other words, you've got a big unit, and you can just bring in a smaller operation that is going to, both sides are going to be enhanced by those bolt-on acquisitions. So both of those are pretty obvious bolt-on acquisitions, if you like, Spotify and 2U. But I am have been looking at, I don't like Twitter anymore. Peloton I was quite excited about, but sure, that price has run. There's always opportunities. Just do your homework and you'll find them. But we don't have any that I can tell you about now.
I saw on Peloton, like they're looking to launch the ergo machines now in-house. I think there's a big shift away from gyms and stuff. And obviously they were purely bikes, but now I think they're trying to grow that portfolio, which is quite interesting.
I'm a bit worried about that, because when you get normality returning, the people are going to go back to gyms because of the social aspect of it. And we see normality will return. And look at British soccer.
Yeah, I agree. There was that article in the Wall Street Journal on the normality, though, with the office-bound workers. And they said the longer it goes on that you keep them away, the harder it is to get them back into the office.
Sure. And we know from our own experience, we were a remote company, completely remote for many, many years, or many years in our existence, but we know the benefits of not being remote. So it's funny, it's like you're ahead of the curve because you did things that seemed a good idea or you were forced into at the time, and then you need to apply your experience. We read a lot and we get lots of ideas, but it doesn't always, what it makes sense for somebody else is not always making sense for you.
For sure. Tace asks, on the new portfolio, will it be possible to buy into it on easy equities?
No, this is a Standard Bank webinar. So no, that's very naughty, Tace. Have a look at the bottom there. You see it says Standard Bank.
No, we wouldn't do that in any. We've done that before. We wouldn't want to have.
No, we'll never do that again. So and with Standard Bank, what is interesting, I know Brett Duncan continues to tell us about this, that Standard Bank's got Shift, and Shift gives access to stocks at the same price as easy equities as well. So there's lots happening in this space. I mean, we love easy equities. We think the fractional investing is a fantastic thing, but this portfolio it does allow you to invest anywhere in the world, which through WebTrader, whereas Easy's only covering US and Oz and South Africa. So Easy does have its limitations at the moment, but we will definitely not have a portfolio that you can invest in. This is a model portfolio. It's really, the intention is so that you look at these stocks, you then decide how you want to play them yourself.
Andrew says, on the new portfolio, how much should he save up?
Yeah, we're going to keep it pretty modest, and we'll work on 100,000 Rand. So that'll be about $5,000. You know, nowadays, remember when we started this portfolio, which was in 2014, you could only, to buy one share in a company was, you were paying quite high costs there. Nowadays, you can buy 1/1000th of in a share if you were to use, say, Easy with its fractional investing, and certainly the costs of investing through the Standard Bank WebTrader and now through Shift has dramatically declined. Also, what Standard Bank has got is Auto Share Invest, which a lot of people haven't seen, which you can also put in like 100 Rand a month or 50 Rand a month and that kind of thing. So there are, the world has changed dramatically. So what we'll be doing from December, we'll have a one portfolio of 100,000 Rand, and that will then translate into, say, $5,000 or $7,000.
There's a few questions on your upcoming portfolio, Alec. Derek wants to know, have you started analyzing companies for the new portfolio? And if so, how many do you think you'll start with?
Yeah, you know, this has been a very successful, this portfolio has been extremely successful. And the way, if you look back on it, what we've learned from this, I would like to apply that to the new portfolio as well. I don't think it's going to look very different from what we have here, but the weightings will be different. So that's really the essence of it. That it just makes it easier for people to follow directly what's in that portfolio. There might be one or two surprises that we add to it, but the weightings will definitely be very significantly different.
Alec, I see we're almost at 1 o'clock. Just a question to end with from Pitt. He says, I know it's David Shapiro's one pick ASML. He wants to know your thoughts on investing into the likes of an ASML with a shortage of microchips.
Yeah, I was looking at that. I was also looking at BYD. BYD sadly is in Hong Kong, and I just wouldn't touch anything from Hong Kong. But it's a fantastic business. A little bit like in a different field, BYD is in electric, basically making batteries for electric cars, and the ASML is, as David's been preaching about it, it has a huge lock on a very key part of a developing sector. Is it growing exponentially? Well, for sure, it ticks that box. Is it likely to continue to grow? Has it got a lot of runway? Definitely. Is it value? You've got to question that. And what happened in the past was that with a lot of Discovery was a good example. Discovery was always, I love the company. I'm worried about Discovery in China now there, because I don't think the market has taken the reverse of what's going on into China into account in the valuation of Discovery. I just don't think it has, but it's still a fabulous company. And the same thing with Cloudflare. And when the shock came having done the analysis on the businesses, when you see Discovery at 60 Rand a share, it's a no-brainer to buy it. When you see Cloudflare at $22 a share, or where it was where we bought in, it really was a no-brainer for us because you've done the analysis. And I think that's really where ASML lands. If you do your homework on the company and you understand the company well, and something happens that Mr. Market panics, and you have a reversal in that share price coming back to a level which offers great value, then you must purchase. The thing is to just go chasing a share or chasing any stock is removing your advantage of letting the market serve you rather than you becoming a slave to the market. Remember those two basic principles that Buffett has spoken about and that we should never, ever lose sight of. The principle of Mr. Market being a manic depressive, and as a consequence that the share prices are going to change due to animal spirits or whatever you want to call it. They are going to be volatile. And the second thing is that when you buy into a share, have a margin of safety. Look to buy it for at least 20% less than what you value that share at. If you can do that, if you can follow those two principles, then you won't be the person who's handing over your money to someone else to handle because you've made an awful hash of your investments in the share market. And that's really what this webinar is about. It's not for me to give you some guru's insight into what you should be buying. It's more to stimulate ideas, to understand a little better how the investment universe works, and to give you a few suggestions that you can go and do your homework on and structure your portfolio around that. You might, for instance, think that Zero is a fantastic, I think it's a fantastic stock, a fantastic company. It should be at least 20% of your portfolio, for instance. If you, let's just say you're a chartered accountant and you've seen how your industry is changing and how Zero is changing it and transforming it, and that the rest of the world hasn't really caught up to it yet. Maybe that's what you would be doing. So very many times all I'm trying to do here is to say this is the way things are developing, and actually every month we come back and we have a look at it and we see, have things been moving in the direction that we anticipated?
Lovely, thanks, Alec. I think we can leave it there. I know we'll be back last Tuesday of the month in September. We've got the conference next week, which is why we moved it back.
Yeah, sorry guys for doing that to you, but you know, we're in the Berg next week, and there's no way we were going to try and leave the conference, which is we're not a huge team here at BizNews, so we weren't going to leave the conference, leave our colleagues to try and handle the delegates and whatever. But if you're coming to the conference, I look forward to seeing you there. Otherwise, we'll be back last Tuesday of next month. Until then, cheerio. Thank you for joining us for this webinar, which is compiled and produced by the team at biznews.com. A recording of this webinar will be available later today on the biznews.com channel on YouTube. From our team, until the next time, cheerio.